it's like I said in my most recent article, what COMEX is saying is the case for gold is now almost too obvious for anyone who takes a half an hour to understand what the COMEX really does and what these flows really mean.
This is Kaiser Johnson with Liberty and Finance. Right now, you can swap any uncirculated 1-ounce gold coin or 1-ounce carded bar for an MS62 $20 Liberty or St. Gaudens with no extra premium whatsoever. Just ship us your gold coins or bars and exchange them for MS62 numismatic Liberty or St. Gaudens at no extra cost. Call us for details.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Matthew Piepenburg from Van Greyers AG. Matthew, thank you so much for joining us today.
Well, thanks for having me back, Elijah. It's always a pleasure.
Well, it's great to have you today. I did want to discuss the outflows of gold from London as we're seeing gold at all-time highs. In January, we saw millions and millions of ounces of gold flow from London to the US. So what is your perspective on what's happening right now?
Yeah, obviously it's a lot. All of us in the industry certainly track this, and I think you and most of your viewers kind of get a sense of what's going on. As usual, we can rely on the mainstream financial media to give us very eloquent but misleading reports. To your point, massive outflows from the London exchange to the New York COMEX exchange, which is the futures market. We're looking at 400 metric tons since just pre-Trump entering the White House just in the last few months, over 75% increase in physical gold at these COMEX warehouses. And again, for anyone who kind of accepts what we've known for years, and I've written about for years without a tinfoil hat, that we know that there's a permanent boot to the neck of the gold price every morning at 8:30 a.m. out of the New York Exchange. A number of too big to fail banks and bullion banks, about 8:30 every morning, they have a large paper futures contract short to dwarf the physical gold price. It's not a conspiracy theory. We know that happens. And we know that under certain regs, they can lever a certain amount of physical gold against a certain amount of paper. Typically, it's 4% physical gold and 96% paper contracts to keep a permanent short, really, to legally price fix gold and silver. And what we've seen in the last few months, which is no surprise, is the COMEX is thirsty for more physical gold for a number of reasons. The headlines say that the COMEX is worried about tariffs under the new administration on gold imports, so we got to get gold in now before those tariffs kick in. The other very eloquent and reasonable argument is there's a price arbitrage between the spot catch price in London and the futures market in New York. And so you got to move this physical gold to do an arbitrage play. Again, to the average person reading the New York Times or the Wall Street Journal who doesn't track COMEX or futures markets, that sounds perfectly reasonable. The obvious reason to any of us who understand, whether it's Peter Umbro who brought this out or the WikiLeaks years ago, since 1974, the reason the COMEX was created was to legally price fix the gold price. And the way to do that is to have a certain amount of physical gold on tap so that you could meet Basel III regulations and commit to this legalized futures contract price fixing. What's happened now is the COMEX is running out of physical gold. And why? Because typically on the COMEX for years and years and years over a generation, these futures contracts are just rolled over in a perpetual game of we'll pretend to order, you'll pretend to buy, we'll pretend to take delivery. But really what happens is we just extend the contracts. All the futures contracts for very cheap are just renewed for almost no cost because that just keeps the liquidity, quote unquote, the trade moving. But what's happened now is you're seeing a 750% increase in open interest on the futures market. That's fancy lad talk for counterparties on the COMEX actually want their physical gold. Okay, they want their physical gold out of the warehouses, and the COMEX in New York simply didn't have enough. And so what does that mean? Well, it means a number of things. First of all, it means, as Andy Schectman and many of us have been talking about for years, this game can only go on as long as the COMEX has the physical gold. But the reason they don't have the physical gold, for all the reasons the BRICS are de-dollarizing, and from the reasons Charles de Gaulle came into New York Harbor in 1971 and the Germans in 2016 and India and China since, why everyone's repatriating their physical gold. They want their physical gold because they think of it as a better tier one strategic reserve asset than a U.S. Treasury or an IOU from Uncle Sam, who has a weaponized and over-indebted dollar and untrusted IOU or U.S. Treasury. It's that simple. And so countries, counterparties, trading desks, you name it, want actual physical gold, which is completely new to the churn and burn, keep it spinning and rolled over COMEX market of old. And so what we're seeing here is a fascinating symptom of what is not being discussed openly. This is not tariffs. This is not price arbitrage between New York and London. This is a world turning away from the U.S. Treasury as a tier one asset, turning away from the U.S. dollar as a safe asset, and preferring that boring analog pet rock physical gold as a strategic asset, as the BIS has warned, as the BRICS have shown, as frankly even the Trump administration and Scott Bessent recognize. Scott Bessent's a very big gold investor. But you can't say the quiet part out loud. You can't have the New York Times, the Wall Street Journal. I'm not a conspiracy quack, but you can't say the world wants its gold. COMEX is being drained because no one trusts Uncle Sam's IOU. Physical delivery is going out the door for a reason. You can't say that because what that means is the gold price is rising, as we're seeing, all-time highs in all currencies at the same time this is going on. This is not a coincidence. If the gold price rises, this is a thing that terrified Kissinger and Nixon and Volcker years ago. If the gold price rises out of control of the COMEX and the permanent boot to the neck under the futures market, that means the U.S. dollar, the mighty dollar, and the U.S. 10-year Treasury, the IOU, simply isn't what it used to be. Doesn't mean the end of the dollar, doesn't mean the end of the world reserve currency, doesn't mean the end of the 10-year IOU. It just means that we're no longer talking about when things are breaking down. They are breaking down. And so what we're seeing in the COMEX market is absolutely fascinating. It's record levels of physical delivery coming in and physical delivery going out. In terms of the gold price, there are two ways to look at this. You could say, well, okay, I hear you, Matt, but they needed physical gold to continue this post-Basel III short. They needed more physical gold to play this paper contract game. Now they've got it. Can't they now continue to exercise the ratio of 4% gold, 96% paper, and keep shorting gold or silver? What I'm saying is that depends on if the gold that's coming in, the 400 metric tons and counting, either stays put or is a revolving door to keep going out so that the COMEX can meet its delivery demands. So the question will be, is the gold stockpile on the COMEX warehouses a movable feast, revolving door going right back out, or is it being restockpiled to continue the short? And that's to be determined, but gold's reaching all-time highs. My view is, and what we have to be careful and what we need to watch, is what we're really seeing fascinatingly is the world wants physical delivery. The COMEX didn't have enough. It's going right back out. And what that means, again, not the end of the world, not the end of the dollar, not gold going to 20,000 tomorrow, but we're getting fair and fair price discovery. The COMEX is running out of its traditional tricks. It's trying to reload its gold. How long it can hold it there is to be determined. But regardless of predicting that, what we do know is what we've been arguing for years and for months and now for weeks and days. This was going to break. I've been writing about the COMEX for 3 years. I said, just keep waiting until they need more physical gold because they run out because there's more demand for delivery, more open interest, which is ratcheting up to the moon. That is a sign that the world is no longer just kind of curious about worrying about the U.S. Treasury or worrying about the U.S. debt levels or worried about Uncle Sam's IOUs. No, they're generally, absolutely, openly and obviously worried now. Again, that's what we're seeing. And that's the real truth. Trust in the dollar, trust in the 10-year, trust in the U.S. Sobriety, mental health, physical monetary health is now clearly at its all-time lowest in years. And that's why we're seeing this move. It's absolutely tied to the debt, to the treasury market, to the currency market, to the precious metals market, to our monetary policy. It's all tied together. And the COMEX is just the latest symptom. When you combine the COMEX outflows and inflows with the treasury auctions that since 2022 or 2000, really since 2014 have been net buyers of gold and net sellers of treasury, that's a symptom that they don't trust the dollar and the treasury. And if you look at since we weaponized the U.S. Treasury under the Putin sanctions, whether you like them or not, whether you agree with them or not, The annual central bank purchase of physical gold has doubled since 2022. These are all connected. The distrust of the US IOU, the preference for a tier one asset and physical analog pet rock gold form is higher than that paper IOU from Uncle Sam. It's really that simple. It's dramatic. It's not the end of the world, but it's like I said in my most recent article, what COMEX is saying is the case for gold is now almost too obvious for anyone who takes a half an hour to understand what the COMEX really does and what these flows really mean. And again, Sheckman, Alistair, McLeod, all of us, anyone who's been tracking the COMEX and understands what goes on there sees this very clearly. And I'm sure most of your viewers and audience does too. It's really quite sad and quite expected and quite predictable. And now it's no longer projecting or saying there's a problem. It's happening in real time right now. It's happening in real time.
So it seems like basically what you're saying is this manipulation that so many people have talked about for so long and argued that this is happening. This manipulation is coming to an end, and that's why we're seeing gold, at all-time highs here.
Well, it's a combination with so many things. It is clearly putting a threat to the manipulation. That game that's been going on since 1974 just saw a twist. They just lost their best pitcher, so to speak. Their third baseman, their shortstop, and their best pitcher just got injured. That game is now changed. The question is, as they've taken 400 metric tons and counting in the last few months, the last few weeks, will they have that available to continue a new lefty or a new curveball and continue this game? Or will the gold go right back out for delivery? That'll be interesting to see. But regardless if they can continue this, that certainly is one of the reasons the gold price continues to rise. Because the manipulation ability, the curveball, the fastball, the heater is less than it was a month ago. But in addition to that, the ongoing continued purchasing by central banks is still going. So the combination of Eastern central bank purchases and the COMEX price fix in New York simultaneously pro gold is undeniable. And the question now is, it's just, as I've said many times, this is just the first inning in the gold price. This is just the first inning, not peak gold. And the sad reality is we can talk about all the other things that Trump is doing and all the positive new wind and new energy. The debt crisis, the same things we've been talking about for years are coming to roost now. And again, what happens when the 10-year yield goes past 5, 6, 7%? What happens when mortgages go past 9%? Who will purchase the next 10 trillion in U.S. treasuries that need to be rolled over in the next year? We can argue about McKinley or Hoover and the tariffs and whether that'll be good or bad for the U.S. or inflation. And we can argue about one executive order after the next at Doge or the USAID or whether executive order after the next will help. But we're missing the lighthouse through the fog. All this energy is important. But the lighthouse, be very clear, the lighthouse is we have too much debt. Our U.S. Treasury is no longer considered the most favored strategic savings reserve asset by the rest of the world. That is the reality because our debt has gone from 36% of GDP to 125% of GDP, from 246 billion in 1971 to nearly 37 trillion today. That is the simple lighthouse. Again, all of these stuff we can talk about: tariffs, trade, Doge, USAID, cutting spending, Musk, Trump. All of it's important, but the real problem is it's all fog. No matter how well-intended, bad-intended, whether you love it or hate it, no one, including Santa Claus or Papa Smurf, can get around the fact that our debt is too big. No one trusts our sovereign debt anymore. They prefer physical gold. That's not a gold bug argument. That's history in motion. And it's really important that what we're seeing on the COMEX and what we're seeing at the Treasury auctions and what we're seeing at a doubling of U.S. gold purchases by central banks since we weaponized the world reserve currency. This is not a coincidence. This is not a gold bug case. This is history happening right now, Elijah, right in front of us.
Do you think then things have fundamentally shifted and the trajectory for the gold prices more, just upwards from here rather than, a lot of resistance and what we've been seeing for the last 10 years of kind of up and down prices? Do you think it's going to be, a faster move towards the upside from here if, this manipulation that a lot of people have argued is happening is really coming to an end here?
Yeah, no, it's like I was listening to Alistair McLeod talking to Dunnigan the other day, and we were talking about this notion of can kicking, us gold buns, because, we talk about how the debt's been kicking the can. as Alistair rightly said, we're not even talking about the can kick anymore. The can has been kicked. Now we're hitting that point where the debt really is now mattering. So the gold price direction is now going to accelerate. Even von Mises warned about this, but that was in the 1950s. We're 2024, 2025 now. Now the debt problem is no longer academic, even though I never thought it was. This was just a matter of time and how long we could go. What we're seeing is it's no longer debatable. Now we've hit that wall. That does not mean that gold only goes in a straight line. But what we are seeing now, undeniably, in the last couple of years and really gaining momentum in the last year and a half and certainly the last few weeks, is that, again, the gold market is going to go into a secular bull market, not because gold's properties have changed or gold has gotten shinier or more interesting or more aware. And frankly, the West still doesn't understand gold. The gold market is rising because the fiat money world, the US credit system, the global credit system, which is money to them, which is just credit, is in a clear bear market. And the most simple way to say that and show that is you have to remember, it's a fiat bear market. A 400 ounce bar of gold, when we had 1971, before we went up the gold standard, I think it was 17,000. A 400 ounce bar of gold today is 1.14 million. Again, gold has not gotten stronger since 1971. The US dollar has gotten weaker. That's why the gold price is rising. The dollar is getting weaker because it's been monetized to an extreme and criminal degree to cover US debt levels, which are beyond the pale of rational, the highest debt levels in the history of the world, and certainly in the history of America. If debt destroys currencies and debt destroys empires, we are at that turning point. Again, not the end of the world, but a very different world. Not the end of the world reserve currency, but a very different currency, respect-wise, use-wise, tier-wise, strategically reserved-wise. The de-dollarization of the BRICS is not a joke. The de-dollarization of the COMEX is not a joke. The move towards gold is not a gold bug argument. It's history in motion. And the price of a gold bar, a 400 ounce bar from 17,000 to over $1 million is not a gold bug argument. It is a symptom of fiat money in general, and the US dollar in particular dying. So people need to get past people talking their book or gold guys talking up gold. But of course, gold is going to go higher because there is no way out of this debt crisis. There are three options, Elijah. There are three options with gold. Or the US debt crisis. We can default, which I don't think is a real option because we have a money printer. We can add a zero at any central bank and solve the default problem. We can try to produce our way out of this debt crisis through GDP, but as von Mises or David Hume or Ernest Hemingway or any good professor in any business school will tell you, when your debt to GDP crosses 100% and gets into the 125%, mathematically your growth stalls by 1/3. So we can't grow our way out. So the only other option, the third option, is to inflate our way out. We're debasing the currency. As we debase the currency, gold goes up. As gold goes up, nations and counterparties on the COMEX want their gold out of the warehouses, and nations around the world want to buy twice as much gold as they did pre-2022. They're buying twice as much now because they trust gold more. It's that simple. Does that mean that gold will only go in a straight line? No, because if we do eventually see mean reversion in the market, I'll say this, if the markets go down 50, 60, 70%, as they should at some point, unless we nationalize them, literally, we could do that. But in a moment of mean reversion or even a recession, anything that's not nailed down is going to be necessary to cover margins. And so gold could retrace. We can't be certain of that, but even as a gold executive, I can't just say gold only goes up and to the right. So of course, but the trajectory, secular, 3,000, 3,500, 4,000 is just the beginning. And that shouldn't be to get your juices flowing for speculation. You should buy gold for 20, 30 years out for the long term, because there's no miracle for paper money anymore. We're seeing extreme examples of that right now at the Treasury auctions, at the COMEX, among the BRICS nations, all of which have their own problems, by the way. It's not as if the BRICS are totally healthy and America's the only one ill. It's not as if the things that Trump is trying to do to cut spending are totally naive. What I'm saying is it's far too little, far too late. And so to your question, yes, gold will continue to go higher, not in a straight line. Of course, if we have a real crisis in the markets and the markets are got plenty of needles pointed at their red balloon, you could see a small retracement in gold and then really ricking high to all-time highs. If you're a speculator in gold and you're waiting for that price pullback, fine. If you're an owner and you're looking 30 years out, whether you buy tomorrow or wait for a pullback is irrelevant. And that's why it's a good question, But my simple answer is I just never look at the price because I just know it's going to get significantly higher by the time my grandkids and kids that I need it 20, 30 years out. That's my horizon. It's always been that way.
What's your take on the strange difference in, I guess, the how the investors are reacting, whether the big investors, maybe taking gold from London and moving into the COMEX or whatever, and then you have the retail investors where a lot of them are selling, or there's not as much demand right now, where we're seeing premiums on the buy and sell side just getting slashed right now. Your take on that? Why is the retail investor seemingly not, moving into gold as the insiders are?
Look, it's not their fault, and it's totally understandable. I've said this many times. It's not a conspiracy theory. Again, there's a deliberate process in my education in the U.S. from kindergarten to grad school, in our media, in our banks, in our registered investment advisory offices, and our prop desk at Goldman Sachs, to the PW, private wealth management at Morgan Stanley or Barclays, to Wharton, Harvard Business School, etc. No one is taught about sound money or gold. No one is. We're talking about optimizing. We're talking about rate of return. We're talking about volatility in the precious metal space and focus on risk assets, annualized return, fight inflation through diversification in stocks, etc. In other words, there's a deliberate misunderstanding of physical gold because physical gold is about sound money, and the entire raison d'etre to the American system post-1971 is unsound money. So it's not discussed. There is no Austrian school from Wharton to Darden to Harvard to Yale School of Management. Whereas if you come to Europe or you come to the East, these conversations are daily had. And as someone who works out of Zurich with clients in Singapore and Istanbul and all over the world in 90 countries, including many from America who get this is not unusual for the East. It is extremely hard for the Americans, not because they're stupid. It's because they've never been taught this deliberately. They're meant to misunderstand this. The government, the central banks, and the education system, knowing their unknowingly, doesn't teach it. Because it's really the biggest fear, a system that's debt-based like America has post-71, the biggest fear that system has is a full understanding of physical gold as a wealth preservation asset against dying fiat money. So it isn't even a conspiracy theory. It's a natural survival instinct. So a lot of retail investors, they're told gold is too volatile. It's outperformed the S&P this entire century. Of course, not in a straight line, but of course it's not too volatile. And the direction is not about gold as a volatile precious metal. It's about an alternative money source, sounder money, not just a hard asset. It's not understood in the West. Retail investors, they're being taught by their advisors and their DNA and our culture. Look, is opportunity cost in gold? Yeah, it's up 25, 27%. But you know what? NVIDIA can go up higher. A good tech stock can go up. Bitcoin, you can't beat its annualized return, etc. There's always something shinier or better. There's always an opportunity cost. There's always something to optimize. The Western American mindset, I come from it. I was a speculator. I certainly respect it. I understand it. It is not thinking wealth preservation. It's thinking, how do I get more? How do I optimize? How do I get a better return? Even though the returns on gold are fantastic. The idea that the great American dollar, like the flag on Iwo Jima, could ever come down is unthinkable. It's not taught. It's not discussed. It's deliberately misunderstood. Whereas in the East, it's very well understood. So there's no coincidence that Eastern central banks are stacking physical gold. The World Gold Council has no clue how much gold is being stacked in China and Russia and the East. But we do know that England, housewives in India have more gold in the entire country of the UK. They have nothing because Gordon Brown got rid of it when they thought that the British pound sterling was good enough. So you're seeing a seismic shift in a West versus East understanding, in a retail versus sophisticated understanding. There are plenty of young or not necessarily highly affluent retail investors in America, though, who fully understand gold and silver. And they do, but they're a minority. And they've been deliberately kind of sidelined. But again, we have clients from 90 countries. We have many clients from America. I cannot divulge, but they put in tens and tens of millions of dollars in physical gold. They're not quacks. They're not conspiracy theorists. They're not kooks. They're fairly sophisticated people. Many of them are bankers who understand sound money. That's it. Unfortunately, our culture, my country, the US I come from, this was not taught. It just was not spoken about. It wasn't even encouraged at the banks I worked with or the prop desks I traded from. It wasn't encouraged. And again, it's not a conspiracy, but there was a deliberate decision to just go around that particular issue. Whereas in the East, who countries who've been through war, who've been through inflation, who've been through regime change, who've seen things go from the sublime to ridiculous. Gold is very carefully understood. It's certainly in Switzerland, it's very carefully understood. These aren't quacks. They just understand sound money and history and inflation and currency debasement and how it's all linked together.
Well, Matthew, really appreciate your time today and really sharing these insights about, what's happening with London and the COMEX and really how that ties into the bigger picture of the manipulation that so many have argued is going on. If our viewers are interested in continuing to track this with you, they can go to vg.gold. Very simple URL there. Fantastic. And go to, I think the authors tab. We'll put a link in the description there to find your writings. Anything else you'd like to leave with our viewers here?
No, again, there's a lot happening and you've got to trust your own judgment, look at counter arguments. There's a lot happening in the Bitcoin side. That's a whole other conversation. There's a lot happening in the COMEX. There's a lot happening in the treasury auctions. Just, again, try to step outside of gold versus Bitcoin or gold versus the dollar or the PXY, or just look at sound money, look at history, look at U.S. debt levels. It really is tied together. It's way past the gold debate. It's more about historic history in motion right now. And this is what happens. Not the end of the world, not the end of America. What's a massive change happening right now, not tomorrow, not yesterday, right now.
Fantastic. Matthew, once again, thank you so much for your time and God bless.
God bless, Elijah. Thank you.
This is Kaiser Johnson with Liberty and Finance. Right now, you can swap any uncirculated 1-ounce gold coin or 1-ounce carded bar for an MS62 $20 Liberty or St. Gaudens with no extra premium whatsoever. Just ship us your gold coins or bars and exchange them for MS62 numismatic Liberty or St. Gaudens at no extra cost. Call us for details.